Welcome back. Joining us for a look at the day's markets action is Graeme Franck from PSG Wealth, Sandton Grayston. Graeme, thanks so much for your time today. Now, let's start off with a general market sentiment. Now, U.S. markets have really been powering through. If it's not the AI boom just fueling that rally, we have some sort of rate cut euphoria coming back and just fueling markets yet again. As Jay Powell now, he's cautioned against keeping rates high for longer. Graeme, what have you made of these comments in particular, and how have markets generally clinched onto these comments yet again? I feel like sometimes we see Powell a tad bit hawkish, but markets just jumping up.
Yeah, I mean, as I think I've said on this program a couple of times, it's been very much the theme this year. We went into the start of this year with the market expecting 6 25 basis points cuts, so that's 1.5%. The market's now expecting 2 25 basis point cuts, so yeah, that's 0.5%. I looked earlier, the market's now, well, there's a 73% chance of a 25 basis point cut in September. And I think that's really why the market is taking heed and rallying. Interest rate cuts are obviously very good for high PE growth stocks like the technology sector. So yeah, I mean the market's swinging around by inflation and interest rate expectations, but the latest round seems to be that we will now get a cut in September.
Now, earnings season is about to kick off, Graeme, and while I was watching Stockwatch yesterday, one of the guests said U.S. earnings are expected to jump by, or to grow rather, by 8.8%. But when you strip out the top 10 companies, earnings growth is pretty much flat. Are we seeing most of the U.S. markets being fueled by that AI stocks, rather, those tech stocks in particular?
Yeah, 100%. I mean, as you said, the top 10, even the Magnificent Seven, are what's driving the market. As I think you said in your introduction, we expect earnings season to start this week. And absolutely, the technology shares and the top 10 shares are going to be the ones that people watch. And ironically, NVIDIA within that is the one bellwether AI stock that people are watching as almost like a litmus test for the rest of the technology sector, which in turn is a litmus test for the rest of the US market. So absolutely, very concentrated, a very concentrated risk at the top of those top 10 shares. And ironically, it's quarterly earnings, so it's such a short-term focus. But the market absolutely does focus on that, and as I say, we're kicking that off this week, and it's going to be absolutely key to the direction of markets for the next sort of week or two or three.
Let's talk about AI, or rather continue talking about AI. Chip maker TSMC also benefiting from that, great boom or great demand within that sector. The firm posting a 40% rise in its second quarter sales. Is TSMC one that you follow in that chip making space?
No. Well, it's one we follow with interest as an indication of the rest of the AI sector. We don't personally own it in any of our portfolios, but certainly it gives a good indication of what to expect for the NVIDIAs and even the Microsoft and Google's part of their AI. So certainly it's a good number, and we would expect that to be kind of a forewarning of what's to come in the rest of the technology sector. We tend to focus on some of the older school tech in our portfolios, if that makes sense. So those shares that have got strong cash flows and strong balance sheet, Microsoft, Apple, Google, etc. We're less keen on some of these new age tech because I think the valuations are a little bit racy.
All right, so let's bring it back home and look at the rand, really gaining momentum. The last time I checked, it was at 18.12 to the dollar. Is the recent strength just on the back of, the weakness we've been seeing in the dollar? Is it nothing we can pinpoint to anything happening locally?
I think it's a little bit of both. I think you're right that the weakness in the dollar, I've always said global winds tend to blow stronger than local winds. So yes, offshore, whatever happens offshore tends to have a bigger impact on the rand. But certainly I think some sort of hope on the coalition is also adding some sort of strength to the rand. And we've seen that also play out in SA Inc. shares. So on the one hand, you've got the currency, and on the other hand, you've got, the banks, the retailers, the industrial companies, which if you took I looked at it earlier. If you look at the share price performance of a basket of SA Inc. shares, i.e., as I say, the retailers, banks, industrials, compared to a basket of Rand hedge shares, the British American Tobacco, Richemont, Anheuser-Busch, the SA Inc. shares have performed dramatically better. So I think it's a little bit of both. Hope that the South African political landscape will improve, and of course, as you said, a weaker dollar.
Let's talk about Pick n Pay for a sec. It's finally received approval for that rights offer, and this, of course, is part of its plan to get its balance sheet in order. The stock ended the day up over 2%. Is this on the back of the general positive market sentiment we're seeing, or are we seeing markets and traders a bit more optimistic about where the company is moving to?
I think a little bit of both. I think that Pick n Pay's had some big problems coming up until now. They've got Sean Summers back at the helm. I think the rights issue is a combination of shoring up the balance sheet and, of course, starting to invest in some distribution centres where ShopRite has got a massive, massive lead on them. So Pick n Pay and Spar, for that matter, have had some managerial problems over the last year or two, and now they're trying to play catch up with ShopRite. So I think the share price is coming off quite a low base, a bit of a sigh of relief today. I think it opened actually down 1%, and as you say, it ended up 2% on the day. So a lot of hard work ahead for Pick n Pay, but certainly their margins are very low. They can reinvest in distribution centres. So quite a lot to play for, but it's been a disappointing share for the last couple of years.
We'll be watching all those developments quite closely, Graeme. Now, before I let you go, what's your stock pick?
So as I've said in the past, the last couple of months, I've been going for SA Inc. shares, banks, retailers. Today, I'm going to go for a similar theme, but I'm going to go the property sector, so Growth Point. The shares have been hit quite hard on the back of COVID, as I'm sure you've seen, quite a lot of vacancies in the office sector in particular. Just before COVID, it was declaring dividends of R1 interim, just over R1 final, so just over R2. That's dropped to now 50 cents plus 60 cents, so just over R1 in dividends. And on a share price of R12, that's about a 9 to 10% yield. So if you believe, and it's a big if, on that the political landscape will improve and the economy will improve, I think Growth Point will do very, very well as a play on the South African economy.
We wait with bated breath for that economic recovery. Graeme, thanks so much for joining us and just sharing your insights today. That was Graeme Franck from PSG Wealth, Sandton Grayston.